Personal finance, GPS number 2. The student will explain that banks and other financial institutions are businesses that channel funds from savers to investors. Okay. A. Compare services offered by different financial institutions. Well, you have different, first of all, you have to look at what different financial institutions means. You have banks, you have money market accounts and investors, you have credit unions. There's several different options that you have, the stock market, to spread your money around. But the main one we're going to talk about is banks, okay? And the services offered at banks, one main one is checking. Now the checking you'll talk about again with Ms. Gunter's finance presentation, but it's usually a free. You'll get free checking. You don't get any interest with it. It's money that you deposit into the bank, and then you can write checks, pay bills. You can even pay online, which is another service that's offered. You can put it in a savings account. You can put it in a CD and lock it up for time for a little bit higher interest. So these are all things, again, you're going to learn by doing in our projects, but they're really good services that are offered by banks, and banks are a safe place to put your money. Personal finance number 2B. Explain reasons for the spread between interest charged and interest earned. Okay, this is how banks make money. That's the key to that. I mean, you get charged a certain amount of interest when you borrow money from the bank, and when you deposit money in the bank, you get given a certain amount of interest, but it's not nearly as much. Typically, it's around 1 to 3%, depending on the type of structure that your savings account has. And it's a safe place to put your money. But when you borrow the money, typically it's from 5 to 7%. So that gap, the money's and the percentage between the money that's loaned out and the money that's deposited into the bank, that is a way that the bank makes money. So that's the reason why that is. Personal finance, GPS number 2C. Give examples of the direct relationship between risk and return. Okay, this one we are going to have to go a little bit deeper into the different services offered. At the bottom you would have the least amount of risk, and that would be a checking account. Put your money in there and you get it out very quickly. Most of the time you do not earn interest on your checking account. They do have programs that allow you to earn interest in some banks, and you might want to ask about those. But there are certain types of qualifications and things you must do each month to be able to earn that interest. The next one up is a savings account. Again, very safe, but it's low interest, just a straight basic savings account at the bank. So you have, it's very safe, low risk, no, very, very low interest. The next one up is a CD, and a CD, you do lock your money in, and you have to pay penalties and fees to get the money out for a specific amount of time. You might lock it in for a 5-year CD, which would be a long time, and you'd get pretty good interest off of it. Now during that time, the bank's going to take that money and loan it out or invest it. And so your money's out there. It's got a little bit more risk going to it, and it's tough to get to. It's not easily obtainable. So you get a little higher interest on that. The next one up would be a money market account. Again, you put your money in there. The money market company invests that money usually in low risk type of stocks, so it is not a real high risk thing. It's therefore you only get about 4 or 5% on it. You can withdraw your money typically 3 times for every business quarter, and that, because it's a little bit of risk, you'll get a little bit of higher return from it. And then we could look at the stock market. Now obviously if you invest in in a large investment firm where they diversify your money all out, and you've got a lot of money in there. There is a lot more risk with that, so you'll get a lot more return with that. Typically, I mean, I've heard from 8 to 13% return, which it could be good, but you could lose everything as well. Like the stock market's going down right now. A lot of 401ks are in those type of things. Then you have day trading, which would be the highest. I mean, the sky's the limit. You could get 100% return. You could lose every single dime you've got in a day. So it's a high risk, but it's very, very high return. But again, it's very, very high risk. So the higher the risk, the higher the chance for return, but the more danger of losing everything you have. The lower risk, the lower chance. So a lot of people stick right there in the middle, and make some good, interest off bonds and CDs, and there's a lot of options, and mutual funds, dabble a little bit in a 401k, obviously, as they get older. So risk and return, definite connection.